Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise information to real estate professionals looking to build their own customized tax planning playbook. As always, I'm your host, Evan Ross. I'm a tax director with Brown Edwards Company, based out of our Roanoke, Virginia office. For those of you tuning in for the first time or have not had a chance to familiarize yourself with Brown Edwards Company, please go check out our website at your convenience. A link to that website can be found in the description of this podcast. On the website, you'll find more information on some of our other service lines outside of tax, as well as our other office locations and our providers. With all that being said, I would like to introduce to you our guest for today. Also with Brown Edwards Company, we have Vincent Centofanti with, like I said, with Brown Edwards, and he is based out of our Charleston, West Virginia office. Vince, thanks for being here with us today. How are you?
Evan, thanks for having me. I appreciate it. Doing very well this morning.
Great. How are things in West Virginia?
Pretty good. Weather's been nice. We had a cold spell there for a little while, but things have turned up. It's a nice weekend. Everything's good.
Very good. Good to hear. Well, again, thanks for being here with us today. I'd like to give you a chance before we get into the meat of the conversation today, just to give you a chance to introduce yourself. Can you just provide a background on what you do for Brown Edwards and kind of your career path?
Yeah, I think that's a good place to start because my career path at a public accounting firm, I think, is a little unique from a lot of people. So I'll give you my history. I grew up here in Charleston, West Virginia, and I went to high school, college, and graduate school here in Charleston. I went to the University of Charleston, and I studied accounting, and I received my MBA about 10 years ago. And so I started my career in public accounting, like most of us here at Brown Edwards have. And it's funny because this is actually about my third time at Brown Edwards. And I started at a predecessor firm for an internship while I was in my MBA program. And I got an offer from that firm, from Brown Edwards, and a couple others, and I turned both of them down. And so I went with a top 20 firm for a position in tax. I thought at that time I had a little bit of exposure to each of the traditional accounting worlds, and I decided I wanted to go towards something in tax, and it ended up not working out. And I had the opportunity to come back to the predecessor firm, Gibbons and Kawash. And that firm was acquired in 2018 by Brown Edwards, and we merged in with the existing Charleston office here, and that made up about 60 or so people in this office. And so I'd been working that time. When I came back in 2015, I came back with the expectation that I was really going to be doing the tax side of things, individual tax prep, corporate tax prep. But I had the opportunity to get into something called business valuation, which was something I'd never really even heard of at that point in time. We didn't learn about it in school. I didn't learn about it in my graduate classes. So I didn't know much about it. But being a kid right out of school, I was like, I'll do whatever you tell me to. And so I jumped right in, and it seemed like it was something that fit my style pretty well, and I worked very well with the partner at that time. And so after a few months, I kind of told him, I was like, hey, I like this stuff. Can I keep doing it? And so I kind of split my time between tax and business valuation for the first few years of my career. But after maybe the third or fourth year or so, I transitioned fully over into business valuation. And I was with Brown Edwards for about 7 years at that time. And so that took me right past COVID to about 2022. I had an opportunity to leave and work for the national valuation practice at a top 10 CPA firm. And I was there for about 2.5 years. And just recently, about 3 or 4 months ago, I returned to Brown Edwards for, like I said, the third time. And couldn't be happier. I think things are going great. I've got a lot of good opportunities here. I work with a lot of really good clients of the firm and outside the firm. And so again, my career has kind of taken a unique path where I don't fall into some of the traditional buckets that you think of in accounting, be that financial statements, auditing, or tax prep. And so I'm one of the few people in the firm that does some of that outside the box consulting work, a lot of valuations, some forensic accounting as well, and a little bit of litigation support.
Awesome. Well, we're glad that we have you on our team. And in the Roanoke office, maybe you've heard this term before, but we call somebody that comes back a boomerang. I guess you're kind of a double boomerang coming back.
I'm a double boomerang. That's right.
Multiple times. So anyways, we're really glad we have you on board. I'm glad you mentioned that because most people, when they think of a public accounting firm, they typically think of the traditional audit tax services.
Yep.
But Brown Edwards really provides a lot of outside the box services that you may not think of. So,
That's absolutely right. I mean, we do a lot of different services, and I know we'll get into it in a little more detail, but beyond just the traditional accounting side of things, we have a lot of consulting offerings and other type of advisory that we can offer to clients.
definitely. Well, Vince, you kind of alluded to it a little bit earlier, but our topic for today, business valuations. We're going to discuss that a little bit further. Kind of just to kick us off, get us started. Can you just kind of explain what a business valuation is and kind of how that process looks?
Sure, that's a pretty loaded question because I could go on about it for days. So it's my life and it's what I've been doing for the last 10 years. So there's a lot of stuff to talk about, but I'll try to give you the very basics of it. And so the first thing I might want to say is, why would you do a business valuation? And there's a multitude of reasons for why you need one. And I'll go through some of the major ones. Some of the big ones that we use to assist clients on is succession planning, for gifting, for estate tax filings. Those IRS codes require that a detailed valuation by a qualified appraiser be performed in order to check all the boxes to make sure that you meet adequate disclosure and you're not going to get audited by the IRS when it comes time to paying your estate or gift taxes. And so that takes up a bulk of the reason that we do business valuation. Other reasons are there, again, there's a multitude of them. We go through valuations for shareholder disputes, for marital disputes, if you have to value the business pursuant to a divorce proceeding. We do valuations for financial reporting and transaction advisory. A lot of times we'll get a call from a client that they don't know what their business is worth and they don't know how to transition it to the next stage of ownership. And so we'll have opportunities to come in and help establish the value for the first time. They might not have any idea what it's worth, or they may have something in the back of their head, but they want us to confirm that or give them some support to that number that they've got. And so a lot of the valuations that we do are in this planning stage as well, and helping clients figure out what they're worth and then using that to come up with a transition strategy. And so those are kind of the main purposes and why you might do a business valuation. But to get to your actual question of what is a business valuation, it's a pretty lengthy process, and it starts with information gathering. We do a pretty deep look back of a client's financial performance. And so we're going to go back at least 3, ideally 5 years, and we're going to look back at the trends that have taken place over those 5 years. We're going to look at their revenue growth and what those fluctuations have been. We're going to consider anything that could have impacted those types of things. We're going to look at any really expenses down to the line item. We're going to class them into the major classes of expenses and look at any trends that have taken place over the last 5 years. In that, we're also going to do an economic and an industry analysis. So we're going to do a detailed understanding of what that company does, how they operate. We're going to go through a management interview, and we're going to talk about who their customers are and what their market looks like, what kind of products and services they offer, what their asset holdings are, what their facilities are like, and the employment, the workforce, management, and governance. So it's a very detailed investigation of what the company does both quantitatively and qualitatively over the last few years. And then we use that to determine value, because inherently valuation is forward-looking. So we look to the past to help get an idea of what the future may look like. We don't know what the future holds, but we do the best that we can to predict it. And so we use all these past indicators together with market data and rates of return that are expected for this business, and we compare it to those things, and we project out future performance and discount it back to present value. That's the simplest way to explain a business valuation. A valuation includes many different methods and approaches, and we can get into that in more detail if you want me to. But we typically go through an analysis of various different approaches and methods, and we use those to reconcile a value. And then the last step of the process is to go through valuation discounts, which a lot of times are some of the most appealing things to clients when it comes to gift and estate planning, where you're able to transfer high amounts of wealth out of your estate, but at the lowest value because it's through minority interests and with heavy valuation discounts. And so that's the process in a nutshell.
Yeah. Well, in a nutshell, that seems pretty complicated, but it seems like it's a very hands-on process with the client. There's a lot of conversation there. You obviously want to get an accurate number, whether it's the number the client's looking for or not. We do want to get the most accurate number out of the valuation.
Yeah, it's funny you say that because the number that you're looking for, it could be, I could come in too high, I could come in too low. It all depends on what the client's looking for. A lot of times, if you're looking to sell the business, you want the highest number possible.
Yep.
And if you're looking to gift or estate plan, you want the lowest number possible. One of the things that we're required to do is we have to be biased. We have to be independent of our client. We can't work in their favor. We're not advocates for our client. We have to give an opinion of value that is independent of those types of factors and would be independent if somebody else did it. We're technically supposed to come to the same answer as best we can.
Very good. Makes perfect sense. So obviously this is a real estate tax podcast.
Sure.
I want to just kind of get into, so you mentioned valuation. I hear the words valuation and appraisal commingled often.
Sure.
Are those the same? Is there differences? And how do those compare to a just traditional, hey, I'm going to get a real estate appraisal done?
Absolutely. Great question. And so if you think about, you ask if they're interchangeable. And I think if you put the word business in front of them, I'd say yes. If you were going to compare a business valuation to a business appraisal, those are the same things. The key difference is if you called it a business appraisal versus a real estate appraisal, those are distinctly different. And while they carry their similarities, they, again, result in a different answer because you're looking at a different thing. And I think it's important to kind of understand the distinction between those two. And maybe the best thing to do is to talk about the similarities first. And so when you think about a real estate appraisal, which most people are more familiar with than a business appraisal, you're going to go through some of the similar methodologies that I was just talking about before. A real estate appraisal is going to look at a cost approach, which is going to basically estimate the cost to recreate that property. In business valuation, we have the same approach. We call it either the asset approach or the cost approach. And what it does is it looks at the value of the company based on what their balance sheet has, and both tangible and intangible value minus any liabilities that it has on those assets. In a real estate appraisal, you also have the market approach, typically called the sales comparison approach. If you're doing a residential real estate and you look at the house down the street that has the same square footage, it's in the same neighborhood, it sold for $300,000, your house is going to sell for about $300,000 as well. We have a similar approach in business valuation, technically a couple of them. We have one that focuses more on public companies. It's called the guideline public company method. As you know, public companies are traded at an active price every day. You can go on Yahoo Finance and look it up right now. What we do is we take that trading price and compare it to the revenue and the EBITDA of these comparable public companies to determine transaction multiples that we can then apply to our subject company. We have another method under the market approach called the guideline transaction company, which is a similar premise, but it looks at private companies that have sold in recent years. So obviously private companies don't have that trading market that a public company does, but we have a database that we can go to that identifies transaction multiples of these types of companies. So again, we'll look at companies that are most similar to our subject. We'll identify what their trading and transaction multiples were, and then we'll apply those multiples to our subject company. And then the last approach, which is one of the most important ones, is the income approach. And again, in a real estate appraisal, it's going to be the same thing. They're going to look at what rents that property is expected to generate in the future and at some rate of return and discount it back to present value to determine a value. Business valuation is very similar in the sense. We're going to look at cash flows of the business, revenues minus expenses plus any non-cash items to get back to distributable cash flow. We're going to project it into the future until we get to some steady rate of growth, and then we're going to discount it back to present value. And that's going to give us an indication of value from an income approach, not dissimilar from what a real estate appraisal would do. Some of the key differences between a business valuation and a real estate appraisal go back to what we talked about earlier in valuation discounts. A real estate appraisal is going to look at what the value of that subject property is to that individual owner. Whereas a business valuation, you don't have to transfer necessarily the entire property. You could transfer a minority interest in that property and take advantage of those valuation discounts. So I think a pretty broad example that you could apply is if you had $1 million piece of property, be it a warehouse, a large house, whatever, and you gifted that property yourself into a trust, you owned it individually and you gifted it to a trust, you're going to get a real estate appraisal and they're going to say it's $1 million and you're going to gift $1 million into that trust out of your estate. That's all you get. You don't get any valuation discounts. You don't get anything else. The alternative is, if you're going to do a business valuation, what you would do is that property would be owned by an LLC or an S Corp. It could be owned by a sole proprietorship, whatever. But instead of gifting 100% of that business, over time, you could gift pieces of that business. And so if you gifted a fourth of that, or $250,000, instead of just gifting the $250,000 of that property, you'd be able to take a discount in the range of 20 to 50%, depending on a number of factors. And so discounting that number as much as 50%, you'd be gifting $250,000 worth of property, but you're only taking a $125,000 hit, saying you had a 50% valuation discount. And so that's kind of where the key distinctions between a real estate appraisal and a business appraisal or valuation comes in. We can take advantage of these minority interests and the discounts associated with those things. It's a powerful tool for estate planning and succession planning.
Yeah, obviously, yeah, great. Obviously, this isn't an estate planning podcast, but I mean, that's a great concept to realize that if you are trying to transfer property, that maybe it doesn't make sense just to get a real estate appraisal and you're getting that $1 million hit, whereas you can take advantage of some of these discounts with the business valuation or take a portion of it. And
that's right.
Definitely has less of a hit on your lifetime amount.
Yeah, and like you said, it's not an estate planning podcast, but it's important to keep in mind that a lot of the valuations that we do are of holders of real estate or managers of real estate, because those types of companies accrue wealth over a long period of time. You have people that start their businesses early in their career, and over 30, 40 years of holding assets, those appreciate and the portfolio expands significantly. So it's not uncommon for a real estate holding company to be in a taxable estate situation, especially with some of the changes that are coming up in the future.
Yes, of course. So anywho, that kind of rolls me into my next question. Just how valuations come into play with planning for future taxes and planning for the future. So you kind of mentioned estate planning. Can you speak more on kind of how a valuation can impact your future tax situation?
Yeah, there's a lot of different ways. And again, it really relates back to this succession planning strategy, be that through a gift or an estate or a transfer to the next ownership. And I'll let you speak to things like 754 elections, but those are basis step-ups that can be used through gifting or through transfers to related parties to basically redepreciate this property. And I know you can speak more to that type of election than I can, but I know that is a very common tax planning strategy that we see in these types of transfers.
Yes, and we actually had Jacob Reeves out of our Newport News office. He actually did an episode with me not too long ago, just explaining the 754 election and what that looks like. So if anybody wants to look back at that, feel free to check out that episode. Some great content there as well. So very good. So there's a lot going into these business valuations. Is there a standard kind of timeline that it takes for a business valuation to be completed, or does it really vary?
It varies, and a lot of times it varies on the input and the interaction from the client. You mentioned that earlier, that just based on what I described, it sounds like there's a lot of interaction with the client and the company, and that couldn't be further from the truth. I mean, we are starting with a detailed list of information that we request from the company just to get started. So the timeliness of that response, if it's returned quickly, we can get started pretty quickly. I typically quote clients that we can do it in somewhere between 30 and 45 days turnaround from the receipt of the initial information through the date that we deliver a draft report. And I say a draft report because typically what we do is we go through all of our procedures, we put a draft report in front of the client, we go through it in detail with them, either through a presentation or a little bit of correspondence back and forth. But that's kind of the first go around. We give them a draft, let them go through it in detail, make sure there's no significant changes that need made, and then it's finalized with signatures. So the start from when we receive the information to when we issue that first draft is typically in that 30 to 45 day range. If the client is very responsive and the company management is readily available for discussions and interviews, maybe it's less than 30 days. If they're not responsive, obviously it could take, I mean, I've had some that have drug out over a year. Just depends on the responsiveness many times.
I completely understand that. I deal with that in the same concept on my end, that kind of all dependent on how quickly we can get the information. So
Absolutely.
very good. So we've kind of talked a lot of the conversation we've had so far is probably more geared towards real estate holding companies,
Right?
Companies holding, investing in real estate. Now, how about a property management company?
Right.
They're growing. They're continuing to add more properties that they manage each year. How does growth potential in that situation impact the business valuation and what that company may be worth?
Yeah, it has a significant impact. You're absolutely right. So if you think about, like you said, a traditional, maybe a real estate holding company, their value a lot of times is going to come from the value of that property, either through rents or appreciation in value over time. And that growth may be fairly modest in the 2 to 5% range, depending on what rate they're acquiring new properties in their portfolio. But a property manager who really, I mean, growth could be limitless depending on how aggressive they want to go after getting new properties under their umbrella. The growth in value is going to be commensurate with the growth in properties that they're managing, because the more properties they manage, it's going to be an immediate hit to the bottom line. They're going to grow their cash flows, and by growing cash flows, they're going to immediately increase value. With that, by having more properties under management, they're also going to reduce their risk. I mean, we look at valuation, something we didn't talk about is what we call the standard of value. Most times when we do the standard of value, it's defined as fair market value, which is the value between it's a value of a transaction between hypothetical investors. And so what we look at a lot of times is the risk of the company, and we have to determine what a hypothetical investor may be willing to pay for this company. If you've got a small operation and you're maybe only managing a handful of properties, the risk of your business is much higher. What if those properties leave? That's going to make a much larger hit to the bottom line, to the cash flow, and to your value, compared to somebody that had dozens or 100 properties under management. So it kind of works twofold in your favor. One, you're going to increase your cash flows, but two, you're also going to decrease your risk associated with generating those cash flows on an ongoing basis over time.
Very good. Well, we touched on a lot of topics. I just kind of want to summarize everything. What would you say are kind of the major concepts that a business owner should consider related to business valuations?
Sure.
I'll let you kind of take that away. So
yeah, I think there's a couple things. I mean, I think we've talked about some of them already. I think understanding the distinction between owning property in a business, an LLC or sole proprietorship, as opposed to owning it individually. There's advantages to that. Are there disadvantages too? Sure. It's probably a little bit more of a regulatory burden. You have to file an additional tax return. You may have to pay Evan a little bit more to do your LLC return instead of just your personal return. But the benefits that go with that could be significant. I mean, if you're talking about an S corporation or a sole prop, you're still going to pass those taxes through. You're still going to pay them at the individual level. It's not like you're going to pay additional taxes, but you have liability protections by having that property owned outside of your own name personally. The business is going to be responsible for that. With that goes to succession planning. It is easier to move a business out of your name than it is a property because of the options that are available. I mean, you have the ability to assign interests in this business, whether it's general partner interests, limited partner interests. You can have different classes of stock. If you wanted to retain control of this property but get most of the economic interest out of your name, you could own a 1% voting interest that controls the company, and the 99% non-voting interest has no say in how the business or the property is managed, but you can start getting that to the next stage of ownership. And so I think those are some of the key differences. Some of the other major important things for business owners is It could also be easier just to expand that portfolio if you have them all in one bucket. And if you're ever looking at selling the business in the future, it's again easier to transfer the assets out of a business than it would be maybe under your own personal ownership or deeded in yourself or your spouse's name.
Very good. So there's obviously, I mean, there could be a great opportunity to take advantage of a business valuation. So obviously, if there is a major event coming up, considering selling your business, gifting, estate planning, that kind of thing, give Vince a call, reach out to him, because he can help you determine if it makes sense to do a business valuation right now, if maybe it's better to hold off, do it in the future. Obviously, you can discuss that.
Yeah, I mean, and maybe it might be beneficial to understand another offering that we have. So a business valuation, if you think of maybe the accounting world, a business valuation is comparable to an audit. It's the gold standard. We are required to go through all the processes, all the procedures. But you don't have to get an audit. You could get a compilation. You could get a review. Valuation has a similar service. We have something called a calculation, which is not the same level of service as a valuation. We're not required to consider all the same methodology, and we're not required to do that in-depth analysis of the business that I mentioned before. What it does, though, is it still applies similar valuation methodology. We can do it at a much lesser cost, and we can still get to a pretty good number of the value of the company. A lot of times when I get a business owner that calls me that wants to know what their business is worth, but doesn't know what the next steps are, I'm oftentimes going to recommend this to them because it's going to save them quite a bit in costs of what we're going to charge, but it's still going to give them a pretty good rough answer of what the business is worth. We have clients that go through these on an annual basis just so that they can report back to their shareholders or their board of directors or the other owners, maybe a passive investor that just wants to understand the change in value over time. These are relatively cost efficient. They don't cost a lot on your side, and we can still provide a pretty good number and we can update it pretty easily. And so this is another option that we offer to clients, especially when they're not necessarily going through a gift tax return or filing something or it's in a court of law. These are very acceptable for just planning purposes and just kind of getting an idea of what the value is of the business before you know what you're going to do with it.
Great. Yeah, I really appreciate you mentioning those service lines as well, because we kind of focused on business valuations, but there are other options out there that are available if you are interested in exploring the value of your company. So
absolutely.
Thanks
and like Evan said, we're always more than happy to talk to anybody that has questions. Even if it doesn't turn into a job, if it can help you guys find the solution or find the path forward, we're more than happy to do that. And if it turns into a valuation or a calculation, great. And if not, hopefully you're in a better spot than where you were when you picked up the phone.
I completely agree. We're looking in the best interest of our clients, prospects, whoever they are. We want to help them out and their business and their future. So very good. Well, before we wrap up this episode, Vince, I want to give you a chance to just provide your contact information. If people do have follow-up questions or interested in a business valuation, what is the best way to contact you? If you can provide that information.
Sure. My phone number here in the Charleston office is 304-343-4188. Again, just ask for Vince or Vincent and you'll find me. My email address is my first initial and last name. It's VCENTOFANTI@BECPAS.com. Again, Centofanti@BECPAS.com and the number 304-343-4188. And as Evan said, I'd be happy to talk to anybody that has any questions.
Awesome, Vince. I appreciate it. Again, that is a wrap for this episode of the Real Estate Tax Playbook. As always, if you enjoy what you're hearing, please feel free to let your friends, colleagues know. Subscribe wherever you get your podcast, and we look forward to bringing you additional real estate content in the future. Take care.